Hello and welcome to my weekly financial update from RTS Financial Planning. As always, I'm your host, Chartered Financial Planner Carl Roberts. So it's been a pretty bleak week for stock markets around the world, particularly for Europe and the UK, as we've seen some of the largest falls since around March time. And this is all due to the fact that COVID cases are still rising and there's been talk of national lockdowns again. Things are moving quite fast, and even as I speak, France has just announced a national lockdown until the end of November at least, and Germany have also announced a softer lockdown with bars, gyms, restaurants and theatres all closed. So I know you're probably all sick to death of COVID and hear about COVID, but it's dominating the news agenda, it's dominating the stock market, so I thought I'd run a special COVID episode, not to give opinion or take sides on the lockdown debate, but just to present some of the information that our investment committee are looking at and to give you some indication of what markets may do next. So first of all, looking at case numbers, it's clear that Europe is the region that is suffering right now, with case numbers declining in other areas of the world, particularly Southeast Asia. What's also clear is that this second wave is not having as big an impact on hospital admissions and deaths compared to the first wave. And there are a couple of reasons for this. Firstly, we now know more about the virus than we did earlier in the year, and are therefore better placed to treat it. There's been a number of treatments that have proved successful at lowering the death rate from coronavirus. And also, the virus itself may have mutated. Viruses are living things and they do change. Now, it's still early days, and there's clearly a lag between a positive case, a potential hospital admission and a potential death. And this week, the SAGE group of advisors that advises the government on how to handle pandemics in particular, said that the second wave could actually be deadlier than the first, but with a lower and longer peak. So why is it places like China, Hong Kong, South Korea, New Zealand and Australia have been able to keep case numbers relatively low? Well, there's a number of reasons for this, but one thing is they have gone for much tougher and more restrictive lockdowns in these countries, particularly China and Australia. They close borders and go for a suppression tactic where they try to get case numbers basically as low as possible and virtually eliminate the virus before opening up society again. There's also a weather aspect to the virus. We know that sunlight and summer and heat tends to kill the virus more than winter. So as Australia entered their winter, case numbers were rising quite quickly, which is why they went into a lockdown. And they've now come out of an 111-day lockdown in Melbourne. So is lockdown the secret? Well, it's not so easy just to lock down an entire country and society. There are major economic impacts to this, and also health impacts too, with people missing scheduled operations or going to the doctors for other conditions. There's also the educational side. People are not getting educated correctly, and mental health problems for people being isolated. What's interesting though is there doesn't appear to be one single thing that can get the R rate down. It's a combination of things, which is why it's so hard to open up society again. Another thing that's interesting is that severity and strictness of a lockdown does not appear to automatically correspond to a bigger hit to the economy. If we look at China, for example, it had one of the strictest lockdowns in the world, whereas the UK was relatively mild lockdown in comparison. But when you look at the economic hit, the UK has suffered far worse. Now, there are some reasons we can clearly identify for this. The UK economy is much more services based. Think hotels, restaurants, wining and dining, leisure activities, and these have been the areas most impacted by coronavirus, whereas China is much more focused on industry. But over time, the more Europe is impacted and the more Europe suffers, it will eventually fall into China as well, because Europe being China's biggest customer. So how do we get out of this, and what do the markets think? Well, clearly there's a lot of hope pinned on a vaccine and a miracle cure that can get us all back to normal. And progress is being made. But with the virus still so new and so much more to learn about it, there's no guarantee that a vaccine is going to work, or it's going to work for a long period. There are 7 known coronaviruses that can infect humans, one being the common cold, and a cure has never been found for any of them. The stock market crash in March was caused by the uncertainty of COVID-19 and how long lockdowns would impact economies. Once the worst was over, markets regrouped and have been recovering ever since. A repeat of full national lockdowns had not been priced back into the markets, and this is why they are having to readjust right now. Whatever happens next, remember markets are forward-looking. They are thinking and trying to predict what is going to happen in 12 to 18 months' time. Now, as always, is the time to stick to your financial plan and don't be spooked by short-term falls as the market readjusts to new information. If you have spare cash on hand, now might be a good time to invest and pick up some shares at lower prices, particularly if you know what you're doing and you know what is going to happen to the company. Of course, there's always the possibility that markets could fall further in the short term. If you're unsure about anything or you want to have a look at your portfolio with a professional, please get in touch. We do run our own investment strategy called the RTS investment strategy, which factors in all of this data that I've just gone through today. But until next time, stay safe and take care.